This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors, and I'd like to welcome you to our Q2 2021 China A Look Ahead. Please read all the disclosures carefully. China's economy has made a full recovery in almost every segment of their economy. Both manufacturing and service industries are on the mend and back to near normal. Domestic air travel is almost fully recovered, and container shipping is booming. While official targets call for 6% GDP growth, that seems like a significant undershoot, as most experts are calling for plus 8% GDP growth. Unfortunately, the good news is somewhat bad news in the short run. Consumption is still lagging in some segments of the economy, mostly in food and alcohol, as well as catering. But that's not really the bad news. The real bad news is market participants are expecting monetary and fiscal policy to be less accommodative with a full recovery in China's economy. Statements by the premier and bankers' expectations concur that less monetary support is on the horizon. And that's really the bad news. That bad news has led to a contraction in a steamy equity market. Both China A and Hong Kong had corrections during the quarter, reflecting expectations for less fiscal and monetary support. A strengthening dollar that was driven by a very large fiscal support also led to a drawdown in their markets. This pullback is providing an excellent opportunity to buy into equities that have earnings growth expectations in the 40% range while trading at nearly a 40% discount to the S&P 500. This is why we're very optimistic in the short run. Now, the major long-term macro themes for China are still very much in place, and please connect with your advisor to talk through those. Thank you for your time and attention, and please contact your advisor or myself with any comments or questions.